So a quick warning about taxes for US dividends. Just be mindful that implications like capital gains, foreign income, and withholding tax apply because US dividends are classified differently than Canadian dividends. But according to many sources, if using registered retirement accounts for investing, like the RRSP, RRIF, LIRA, and LIF, your investments are protected against these taxes. So for our agenda today, I'll talk about the 9 US dividend ETFs in Canada. I'll make some comparisons amongst them. And finally, I'll give you my higher level thoughts and observations. So introducing the 9 US dividend ETFs, which come from these 6 different platforms. The BMO US Dividend ETF. Here are its top names. They're all fairly big companies that we recognize, and the top 3 companies make 9% of the portfolio. Usually when a stock makes up more than 10% of an ETF's portfolio, which is supposed to have hundreds of names, then I think it should be slightly concerning. The industries are concentrated in tech and financials, and the top 3 make 54% of the portfolio. Personally, I think that any single industry pushing past 30 to 40% of the total portfolio becomes overly concentrated. But as a baseline, if there are 10 industries, then equally they would have a 10% weighting. The ETF's profile is pretty decent, and I would say serves as a good benchmark when looking at any ETF. It has an inception date of 2013, has $447 million in assets, 102 stock holdings, a 3% dividend yield, pays monthly, and has a 0.32% MER ratio. When looking at how total distributions have been paid out, you'll find that it is not equal at all. The spikes represent a single monthly payment that on average represents more than half the whole year's payment. So if dividend yield is 3%, you can expect 1.5% being paid on the 12th month. Viewing the dividends on an annual amount, there's not a consistent trend of growth, so the dividend yield is not very stable. Since 2018, it's actually been declining. Looking at total returns, it's generated mid-single digit returns in recent years, although double digits since inception. Since the expected dividend yield is 3%, you can sort of think of the mid-single digit total returns split half by dividend and half by capital gains. But also conceptually, for the dividend yield, if the dividend has been declining while the ETF price has been increasing, then the dividend yield has been declining over time as a result of both factors. High level to differentiate this ETF, it's fairly old amongst the list. The dividend is heavily weighted in the final month, and the portfolio is focused in tech and financials. Purpose US Dividend Fund. Amongst the top names, I'm not really familiar with most of them, and that in itself might be a slight concern for investors who also don't recognize them. The top 3 names represent 6% of the portfolio, so it's well diversified in that sense. The sectors concentrate towards materials and industrials, and the top 3 represent 35% of the portfolio. For its profile, what really stands out is its super small size of $15 million. It has the least number of holdings at 60 stocks, and the MER is 0.66%, which is pretty high, relatively speaking. I personally like ETFs greater than $100 million in size, has more than 50 stocks, and an MER below 0.5%. For its dividend payments, it's one of the more stable ones where you can better anticipate the amounts that you can receive. But the drawback is that there isn't really evidence of growth, especially since the last 3 years have been the same. For total returns, it's had a good rebound last year, but otherwise over time, it's been doing mid to high single digit returns. To remember this ETF, it's a really small one, has a high MER, and it's focused on materials and industrials. Vanguard US Dividend Appreciation ETF. Amongst the top names, you'll likely recognize most of them, if not all of them. The top 3 make 12% of the portfolio. Its sectors are consumer and industrial focused. The top 3 make 55% of the portfolio. For its profile, this ETF is very good in every area except for the actual dividend, which yields 1.3% and pays quarterly. It's not very captivating as an income-oriented investment, whereby most people are actually looking for at least 3% dividend yield and want it monthly. For dividend payments, it's actually the most consistent ETF, showing growth over time even though it's not a lot. The other important point worth mentioning is that the payments are fairly equal throughout the year. For total returns, this is the best on the list, with low to mid double-digit returns throughout its history. As a comparison, it's worth mentioning that the S&P 500, or VFV, cleared mid to high double-digit returns during the same time period. But the S&P has double the tech concentration, so VGG has done very well with that consideration in mind. On a high level to remember, this ETF is super big and diverse, focuses on consumer and industrial, and pays quarterly dividends. iShares Core MSCI US Quality Dividend ETF. Amongst top names, these are very recognized names, and the top 3 make 12% of the portfolio. Sectors are concentrated in healthcare and consumer staples. The top 3 make 51% of the portfolio. For its profile, it has many of the characteristics that we're looking for, and it has the lowest MER. Looking at dividend payments, it's also one that has very heavily weighted on 1-month spikes, but interestingly, the spikes have been declining over time. But it also hasn't meant that the remaining 11 of the 12 payments have increased. For total returns, we're expecting mid-single digits here. Since it hasn't had a full 5 years of existence, there are no 5-year returns. To remember this ETF, it's one with the lowest MER and is focused on consumers. iShares US High Dividend ETF. Amongst top names is all companies you also recognize. The top 3 names make up 22% of the portfolio, which I think starts to get into the over-concentration territory when there's supposedly over 100 stocks inside. Sectors are concentrated in energy and healthcare. The top 3 are worth 50% of the portfolio. The profile overall is pretty good and has the highest dividend yield of 3.6%. When looking at dividend payments, it's very centered around the year-end spikes, which was increasing at first, but the most recent year didn't have a strong one, so it's a huge setback on the dividends from that standpoint. Otherwise, the other 11 of the 12 payments have been relatively stagnant over time. On total returns, it's been doing roughly low to mid single digits, which actually makes it the worst performing ETF on the list. Just keep in mind that the average is mid to high single digit returns over time. To remember this ETF, it's one with the highest dividend yield and is energy focused. RBC Quant US Dividend Leaders. The top names are mostly recognizable and the top 3 make 18% of the portfolio. Sectors are really concentrated in tech followed by healthcare, and the top 3 make 58% of the portfolio. For the profile, it's pretty fair overall, although on the low end for dividend yield. On dividend payments, it's also working with a spike pattern, and there's no set expectation on how much it'll be since there were gap years. On an annual dividend basis, the growth hasn't been consistent with many negative years as well. For total returns, it's actually one of the stronger ones with low double-digit returns over time. This can be easily explained by the stronger tech orientation, which has more capital gains potential and lower dividend yield. To remember this ETF, it's one that's tech-focused. Fidelity U.S. Dividend for Rising Rates ETF. This ETF sounds like it's the perfect one for current market conditions where everyone is getting scared of rising interest rates, but we'll see how it is done. The top names are pretty recognizable and aren't really different than the other ETFs that we've already seen. The top 3 names represent 12% of the portfolio. Sectors are really concentrated in tech, followed by healthcare. The top 3 are 53% of the portfolio. As for the profile, it's one of the newer ones and it's pretty small for its size. On dividend payments, there's not really much of a history to work with, but based on the 2 full years so far, the payments show signs of the spike closer to December every year, while the remaining months are moderated. The spikes, unlike other ETFs, don't represent too much of the annual dividend. On an annual basis, the dividends have shown some growth. For total returns, again, there isn't a long history yet, but given its portfolio concentration in tech and healthcare, I think that if given the same time frame, the returns would have been really similar but slightly lower to the previous ETF, the RBC Quant US Dividend Leaders. The RBC ETF was doing low double-digit total returns, but I think that over the same time frame, Fidelity would have done high single-digit to low double-digit returns. To remember this ETF, it's one that's small and tech-focused. CI WisdomTree US Quality Dividend Growth ETF. The top names are those that we recognize, with the top 3 representing 14% of the portfolio. It's concentrated in tech and healthcare, which the top 3 represent 60% of the portfolio. For its profile, this one is pretty decent in every area except for the quarterly dividend, but it holds a significant number of stocks. On dividend payments, it changed from a monthly frequency to quarterly after 2018. When looking at the annual dividends, it has not been consistently growing. Total returns history is short, but it's shown roughly low double-digit gains. To remember this ETF, it's one that's very diversified with its number of holdings and has a quarterly dividend. CI WisdomTree US MidCap Dividend ETF. This one I assume would present a dividend ETF with higher risk but higher returns given the nature of investing in smaller companies. Inside, I don't know a majority of these companies, but it's quite diversified with the top 3 names being 4% of the portfolio. For sectors, it's concentrated in financials and industrials, and the top 3 represent 55% of the portfolio. On the profile, the dividend yield is pretty average and there's tons of holdings, but the fund is still really small. On dividend payments, it shows a spike on the December payment, and that represents roughly half of the annual dividend. Over time, on an annual basis, it hasn't really proven to grow. For total returns, there hasn't been a long history, but my guess is it's one that generates mid to high single-digit returns. But based on the concept of mid-cap companies normally giving higher return for higher risk, I don't think that this was the case with this ETF compared to its large-cap ETF peers. To remember this ETF, it's a small one but diversified, and it has quarterly dividends. Now let's compare all the ETFs. So here's a high-level profile of all the US dividend ETFs in Canada placed side by side. The average inception is 2015, with the oldest in 2013 and newest in 2018. The average fund size is 178 million, the biggest being 765 million, and the smallest at 15 million. Average MER is 0.37%, with the lowest at 0.16% and the highest at 0.66%. Average dividend yield is 3%, with the highest at 3.6% and lowest at 1.3%. Average dividend payment is monthly, with some in quarterlies. and average holdings is 145, with the highest at 311 and the lowest at 60. Here's another row comparing them to the average Canadian dividend ETF. Some stark differences are that the Canadian dividend ETFs on average are 5 years older, have triple the fund size, have 2% more in dividend yield, and have only 1/3 of the holdings. Let's talk about the industry concentrations. The first 5, financials, energy, telecom, utilities, and real estate, are normally more dividend-oriented industries. The US dividend ETFs are more broadly diversified amongst the industries, with a heavier weighting in financials and the last 3 industries, consumer, healthcare, and tech. Here's a row comparing them to the average Canadian dividend ETF. You'll find Canada to be more concentrated in the first 5 industries, or typically dividend-oriented industries, and lacking in the remainder. Let's talk about total investment returns. You'll find the numbers to be quite different amongst the ETFs, but I would say that overall the expected return I see on average is roughly mid to high single-digit returns. When comparing to the Canadian dividend ETFs on average, the returns are very similar over longer time frames. But I would say that the difference being that since the average dividend yield of the US dividend ETF is 3%, then less than half of the total returns are made up of the dividend. In contrast, the average dividend yield of the Canadian dividend ETFs is 5%, so more than half of the total returns are the dividend. So here are my high-level observations and conclusions. First, the dividends are not consistent. They're often weighted towards the end of the year with a single large payment representing half of the whole annual dividend. This is often represented by those dividend spikes from the charts. I also don't see any really strong evidence of dividend growth in any ETF. And also, the dividend yield that's stated is often not consistent with how much you can expect every year. The second is that the ETFs with lower dividend yields are higher performing. Often, lower dividend yields imply that the companies inside the portfolios are withholding that income to reinvest in their operations. Vice versa, higher dividend yields means that companies are giving out most of the profits back to the shareholders and lack growth themselves. So lower dividend yields means that the portfolio mostly consists of higher growth companies, and that should also coincide with higher dividend growth, but that wasn't the case for many of these ETFs. Third is that Canadian dividend ETFs give more income compared to the US dividend ETFs. It was 5 versus 3% average dividend yields, while total returns, at least in the last 3 to 5 years, have been roughly the same. This broadly tells me that the Canadian companies can grow at the same rate with US companies with less profits retained, since the profits are mostly passed out as dividends. In other words, if the US dividend ETFs also had a 5% dividend yield, then their total performance would be much worse. If I had to choose the best US dividend ETF from the list, I think it would be the Vanguard US Dividend Appreciation ETF for several reasons. The first, because of income purposes. It was the only ETF with some evidence of stable or slightly growing dividends, and definitely one that had somewhat equal payments throughout the year. For many ETFs, I personally wouldn't want to wait until the final December payment to receive a dividend that represents more than half the annual amount, and sometimes even that payment isn't guaranteed as shown by some ETFs. Even though this ETF's dividend yield is low at 1.3%, at least I think there's a high probability of receiving this amount every year. Second, it had double-digit returns, so even if dividends aren't sufficient enough, an investor would have gained more than enough and could just sell a small portion of shares for cash to supplement the income. Third, it's the largest ETF on the list, very diversified, and has the longest history. But for a better recommendation, I think that selecting yourself 5 to 10 of any of the top stock holdings as a portfolio would generate more consistent income. Amongst all the US dividend ETFs that I talked about today, some of the recurring names that kept appearing amongst the top 10 list include Microsoft, Apple, Home Depot, Procter & Gamble, Coca-Cola, Johnson & Johnson, Visa, and JP Morgan. As an experiment, I made a simulated $10,000 portfolio of these 8 companies to show you. Assuming you held an equal weight in each name and made sure that these weights were maintained every quarter like an ETF, then you would have 12.5% weight in each of the 8 companies. Here's how portfolio income would be every year over the last decade. You'll find that portfolio income has increased every year regardless of when you started, with an average growth rate consistently high in the mid-teens. If you started this portfolio today, the dividend yield is roughly 2%, but you'll find that after a decade of consistent dividend growth, the $1,000 of current annual portfolio income on the simulated $10,000 initial investment became a 10% dividend yield on cost. On total returns, a decade of holding onto this portfolio would have grown to almost $52,000, or a 5 times return. To make the portfolio more comparable to our ETFs, the below show the 1, 3, and 5-year annualized return. Recall that the US dividend ETFs were on average mid to high single-digit returns, and at best low double-digit returns. This simple simulated portfolio doubled to triple the performance of any of the US dividend ETFs from the list. So that's all for now. If you learned something new or enjoyed what I had to say today, remember to like, subscribe, and turn on the notifications for more money-making ideas in the future. Let me know in the comments below your thoughts on the US dividend ETFs, and I'll see you next time.